This is where 90% of traders get faked out. They think it's a breakout, but it's actually a trap. Today, I'm going to show you how to spot these reversal traps early, how to confirm when the trend is truly changing, and how to time your entry with precision using the 2CT entry model so that you stop getting caught and start trading like a sniper. By the end of this video, you will know exactly how to spot a true reversal using price action, avoid chasing fake moves, using the higher time frame and lower time frames to build high probability entries, and enter using the 2CT entry model with confidence. Let's get into it. Here is your standard downtrend. Here you can see price is making lower lows and lower highs, lower lows and lower highs. You can also see with this downtrend that it is very consistent. The push phases here are equal, meaning that there is a consistent shift in momentum to the downside and sellers are in the market. You can also see with the pullbacks that there is least resistance, meaning that the pullbacks are probably just a short pause before the continuation to the downside, meaning that there is a consistent shift in bearish momentum. Now, based on the 2CT entry model, what we're looking for is for price to close on the higher time frames with a consistent range to the downside, meaning that there is nothing abnormal about this range on, let's say, the hourly candle. Then what we anticipate is the natural development of a candle formation. We're looking for price to create a top wick, and once created a top wick, flip bearish in anticipation for price to continue bearish. Once price creates a top wick and then flips bearish, what we then expect is for price to continue in that direction. Now, the idea is that once the market has given the information that we need, which is we are in a clear downtrend, making lower lows and lower highs. Looking at the pullback phases here, we can see least resistance. The next hourly candle or higher time frame candle will continue in that direction, creating what we see here on the lower time frame as a very clear trend to the downside, making lower lows and lower highs. Now, the concept is very simple. What we're doing here is we're just following the bias of the market. In theory, we're trend trading. We're not trying to jump in front of a moving train. We're simply saying to ourselves that once the candle closes bearish on the higher time frames, we have a clear indication on the lower time frames of a trend moving to the downside and the normal formation of a candle, which is top wick first, body next. Price will continue in that direction to give us a higher probability trading setup. Now, the question is, how do we spot a true reversal of price action? Now, take a look at this example. We have a very clear trend to the downside as well, and you can see that it is pretty much top heavy. Price is definitely not bullish. It is going down. Now, there's slight nuances here that we can identify to indicate to us that there's going to be a reversal. Firstly, on the pullbacks, you can see that they are not equal, meaning that there is a higher chance that there is a behavioral shift happening in the market. So currently we can see that we are bearish, but that does not mean we're going to continue bearish, because from the previous example, you will see that we had equal pullbacks and equal pushes, creating average range high time frame candles, indicating to us that the bears were in control. Now, yes, the bears are definitely in control of the market still because it's still going down. However, what we can see here is that the behavior starts to shift. The first indication of a shift of behavior is here. On these pullbacks, you can see that price is slowing down dramatically. They're not equal to the previous pullbacks that we've seen in the trend that has already formed. The continuation breaks here, as you can see, are much smaller and less consistent as the previous breaks. We can also see here that the lower highs that are being formed are much closer in range than the previous breaks. Now, how do we know that the market is going to reverse? Well, first we have to look for a shift in behavior. That means that we're looking for price to indicate to us that we're truly in a bearish market. However, the shift in behavior starts to indicate to us that the bears pressure in the market is starting to deplete. And then what you will usually see is a massive flush in the market before price starts to deplete and show signs that it's failing to make new lows. In this instance, you can see price failing to break. So after the shift in behavior, we have the flush. Then we have the failure to break the lows. And then as you can see here, price is also failing to make any new highs. That being said, we have lost a clear directional bias. Now, usually what happens in the market is we have a very strong push phase from a higher time frame perspective, and then we expect a pullback. Then we have a push phase, and then we expect a pullback. So if we account for how the market moves on a daily basis, then we can confirm that this market is in a downtrend. But due to the shift in behavior and the failure to break, we can also confirm there is a huge depletion in this bearish sentiment with the idea that price can continue bullish. However, we cannot be certain that the market will continue bullish until we have a shift in behavior. So let's jump on the charts. Looking at this chart, we can clearly see the market is in a downtrend. Price is clearly making lower lows and lower highs. Now, what we're looking for here is for price to indicate to us that the shift in momentum is shifting from being bearish to bullish. Now, what we're looking for here, as you can see in this example, is price has created a lower high, a lower low, and a lower high with a very strong push phase. Now, if you look at the range of this candle exceeds the range of the previous 5 candles, meaning that this move is very suspicious. Is that enough to confirm to us a reversal? Well, let's see. What we're looking for here is for price to indicate to us that there is a depletion in this bearish sentiment and a shift in bullish momentum. We didn't quite get that here. As you can see, we have the flush, we have the depletion in that bearish sentiment, but we still closed bearish, and now we have continued bearish. So let's continue to see what happens. Price now, as we anticipate in a downtrend, would usually create a push phase, a pullback, and then a continuation. In this instance, what we can see is that there was a depletion. There wasn't a lower high pullback, but there was what we call a flush. Now, after this flush happens, what we're looking for here now is the shift. As you can see, on this occasion, we have a depletion in that bearish sentiment, but the difference in this scenario is that we have a bullish candle close. So we have a downtrend. We don't have a low high that forms. We have a depletion in that bearish sentiment, but we continue to flush the market. And then as you can see here at this structural low, we have a shift in behavior. Not only do we have a shift in behavior, but we also have what we call equal bodies. This is where price is failing to make new lows, and price sits on that level in line with the previous candle close. What we're looking for next is a shift in behavior. And here we have a bullish candle close. That's the confirmation. That's the change in behavior of the market. But what we've got to do now is we've got to drop down to the 5-minute time frame to get our sniper entry. Now, this is where most traders fumble and force the trade. But here's what you've got to wait for. We know that the market from a higher time frame perspective is bearish. We also know that there was a shift in behavior prior to what we currently see is happening in the markets. The difference is, though, we did not get a bullish confirmation, and neither did we get a bullish behavioral shift to indicate that the bearish sentiment was depleting. What happened next? Well, price continued to push bearish, and then we had a huge flush in the market. Now, what we can see here with this example is that price fails to make a new low. It consolidates and it forms a mini supply zone. We also have an area in the market where price is failing to break above. Now, just remember that this shift in behavior has not started from here. We have an indication prior that the market was bearish. The shift in behavior happened here, and then we have the confirmation here. Now, is this enough? Well, no. We want to be certain that the market is shifting. So we have to wait patiently for the market to change the behavior by breaking the structural high and then clearly indicating to us that the market is no longer in a downtrend and is now truly shifting into an uptrend. What we see here is price breaking the high of this zone. And this is your moment. The shift in behavior has been confirmed. Now that you've got your confirmation, what we have to wait for patiently is for price to do one of two things. We need price to come back to our retest zone to look for that continuation, or you need to see that price is truly shifted by creating higher highs and higher lows. Let's take a look at what happens. In this example, you can see that price comes back to this level. Now we have a shift in that behavior with a strong bullish candle close. What we're looking for here now is an entry. We have our confirmation, we have our retest. Price is failing to push back into that zone, which is a good sign. And now we can use that as an area to place our stop loss. Now you might be asking, where should we target? Well, due to the fact that price has shifted twice with a strong push phase, a shift in behavior, and a second push phase, we can in fact look to trade price back into these structural areas where the push phase has happened prior. This gives us a high probability reversal pattern because we have a very strong, unusual trend to the downside with over average range hourly candles. And more often than not, what price likes to do is correct those moves. And here in this example, you can clearly see that price is pushing to the upside very comfortably. And I'm not saying that every single trade that you take, you need to go for big risk to rewards. I'm just giving you an example here that once price pushes extremely strong in one direction, more often than not, price would like to go back to it. So here is a simple example how you can look for reversals in the market, knowing exactly how to take them and avoid chasing fake moves. And I want you to watch here how the flushes happened, then the indecision, then the bullish 1H close, and then we dropped to the 5-minute time frame. We failed to see the break of the low, the zone started forming, and then the breakout above the high. Your entry is looking for that retest, that shift in momentum, and then watch the market rip. So I hope you enjoyed this one, guys, because I know for a fact that most traders get wrecked at reversals because they react emotionally. This model is going to help you wait for the story to play out before acting. And it's not magic, it's just behavior. Read it right, and you'll never chase a fake move again. Save this one, guys. Study it, backtest it. Reversals are no longer random. Let me know what you think in a comment. Take care, and until the next one, continue to trust the process.